Hello everyone, I'm Conrui. Welcome back to the channel. So in today's episode, we'll be covering these few different things here. First of all, it will be Meta's new frontier model. Second of all is the Iran war. Third of all is earnings from last week and then earnings this week as well. And then last of all is the semiconductor industry and my thoughts on it. So we'll talk about Meta's new break first. So I'm still holding on to Meta shares and I have not trimmed or sold the shares simply because of valuation and skin in the game. So while Zuck is erratic sometimes with his spend, my view is that the company has remained the same. Its sheer distribution capability is second to none, and ROI on capex spend has already shown up in terms of revenue acceleration. So the market has largely misunderstood Meta's capex spend, and with this news coming in, sentiments could start shifting in the favor of Meta. This piece of news is with regards to Meta's new model, and so Zuckerberg also mentioned that the pricing from some other labs is very extreme and has very high margins. So they think that there's real ability to be able to offer Frontier a very high level of intelligence at a much more affordable cost. So for the industry, this really looks like commoditization with two varying perspectives. So one is that it is a race to the bottom where competition pushes for price cuts and compresses margins. So if you look at China, for example, they're distilling the models away from the US and they're providing their models at much lower prices relative to the US. So we could see further decreases in terms of token pricing. The other one is a Jevons paradox for token pricing. So falling token prices creates more usage and total token spend keeps growing even as the per token price falls. So for Meta, the competitive pricing and a strong model is proof that the company has converted its capex into a leading model, similar to Alphabet's Gemini turnaround last year. And with Meta's cloud story coming up, along with this frontier model, sentiments might shift even amidst strong capex spend. So overall, my thoughts on capex is this. While I'm cautious with the capex spend by these companies, I think the markets have already sort of prematurely punished all these companies. So like for example, Microsoft is down 20% year to date. Meta is, I believe, down this year as well. So this presents an opportunity for longer term investors. But of course, position sizing and allocation is key. Capex cycles are cyclical. Revenue acceleration comes after the spend. I think the markets don't really understand that. And importantly, companies have the ability to reduce their capex. So while hyperscalers to your semiconductor rotation continues, if it continues this way, hyperscalers hold the ultimate power to reduce this very capex spend. So it's very odd that the markets have been rewarding one side and punishing the other until just about this week. Next piece of news that I'll be covering is on the Iran war. So geopolitically, we saw a resurgence of the Iran war. So oil prices are up again, and it looks like two kids fighting and arguing over pointless things all over again. And then you have Trump midterm elections coming up, so he probably has to end the war, but he's starting the war again to make himself look better in my opinion. This is a bit of a backstory as well. Trump, he criticized Obama for giving in too much to Iran, and yet now his MOU suggests significantly weaker terms for the US than during the Obama term. So it's a bit of a contradiction. On oil, bypass routes already exist and have expanded or are actively being scaled up. This will weaken Iran's position going forward. So in my opinion, I think what Trump is doing now is like what he always does, which is to escalate before a de-escalation. So if you look back at what he did during the tariff war, it's exactly the same thing. He escalated before de-escalating significantly after seeing the market reaction. I think it's similar here. He's just trying to make himself look a bit stronger, but ultimately his midterm elections are coming up and he has to end the war. Next one, we'll talk about earnings last week. So the banks reported very good earnings. So most of them were up 15 to 20% in terms of EPS growth, with companies like JPM reporting 25% increases in EPS and high teens to mid-20s in terms of your ROE or ROTCE sometimes. But just something to bear in mind. So if you look at the 08 crisis, the 08 global financial crisis, what preceded the crisis was that a lot of your banks had very, very strong earnings going into the crisis. So what they were doing back then was creating a lot of SPV vehicles, leverage, subprime mortgages, your credit default swaps and all that. And that led to very high growth. So what you must understand is that the financial system and the banks are built to help the economy grow. They can grow a bit faster than the economy, but if they grow a lot faster than the economy, then there's something that is probably a bit wrong there because they're applying significant leverage. So great earnings nonetheless, but just something to bear in mind. After the banks, we had some of your other technology companies. So ASML reported very strong earnings and the stock fell, with management guiding for 30% increases in capacity annually over the next 2 years, suggesting even stronger demand for lithography machines. And they also mentioned that they'll be increasing the prices for their EUV machines amidst resistance from TSMC. So for ASML, I think it is important to look at growth from their customers and whether or not demand there remains strong. So for example, you can look at Micron, look at Samsung, look at TSMC, look at Intel. I think a lot of these businesses are doing very well, so naturally ASML will do well as well. Once we see a tip over in 4 of these companies here, then it might be time to reconsider your position in ASML. Next one is Netflix. So Netflix reported earnings. They mostly met expectations, but the stock fell 7% with their earnings report because of fears over weakened engagement metrics. So the management actually came out and said that they'll be removing this metrics number and shifting it over from a quarterly metric to an annually metric. This signaled to the markets that maybe their engagement metrics are weakening and that's why they're not reporting it. But I think for Netflix and 19 times forward earnings today, a lot of the expectations on the stock have been drastically reduced. So the coming key growth drivers for the company is their advertising business, along with continued price increases, with management highlighting that their ads business will approximately double in 2026. In terms of cash flows, it is a timing thing, so I think the markets are overreacting to the drop in terms of their free cash flow number. As for earnings this coming week, we have 2 of the big Mac 7 reporting earnings. And as usual, Tesla is going to miss expectations and the stock will run because of robotaxi stories and robotaxi news by Elon Musk. On Thursday, we have the more serious Mac 7 here, which is Alphabet. So there have been reports of late that the company's own internal compute capacity remains constrained. And this points towards even greater increase in terms of their capex guide. But Alphabet must convince the market that the ROI is strong and that there is acceleration in terms of their growth. So on Alphabet, I think Buffett mentioned during the week that he made the decision to buy Alphabet. And he thinks that Alphabet has the strongest path towards monetization of capex and that the other peers, your other hyperscalers like Amazon, Meta, Microsoft, they are all forced into this capex race. So we'll look for the numbers on Thursday, but capex guide and re-acceleration of growth in terms of cloud revenue as well as search revenue will be key for the company. My thoughts on Alphabet are summarized on this last point here. So the stock is not cheap, but out of all the Mac 7 companies, I think Google is the only one that has, number one, the strongest distribution network. And second of all, it is probably the only company that truly has a fully vertically integrated AI stack. Last one on semis. So there have been quite a number of semiconductor stocks that have fallen between 30 and 50% over this past month. So for example, Micron is down 30%, Kospi is down 30% from the high as well, and then you have Marvell down 50%. Funny enough, the Korean government actually banned issuing of leverage shares in the Korean market. I think this is a wise decision to do. A lot of your Korean people are crazy in terms of leverage. You look into the news, I think 1 in 30 adults were margin called just last week. So for your semiconductor companies, the stock were well ahead of their fundamentals and a lot of them was pure momentum driven before this last week, before this 30 to 50% fall. So now that prices have become more reasonable, although I don't think it's reasonable yet, I'll look into entries for semiconductor names that I feel are extremely strong. So some of them include ASML, AVGO, which is Broadcom, as well as TSMC. So hopefully these semiconductor stocks continually fall. And yeah, let's see if we can get an entry. I hope you guys have found this video useful. This is a new format. Hopefully you guys are enjoying it. And I'll see you guys next week.